Okay, ladies and gentlemen, we are here at the SPAA conference in the exhibition area having a chat with a couple of our presenters and speakers. I have with me here Tim Lawless, who is the research director. He is the number cruncher in the housing market with RP Data. And Tim, thank you very much for coming along.
Thanks for having me.
A couple of questions for you.
Sure.
Tell us, what are some of the opportunities and risks for SMSF trustees who might be looking to invest in this area?
So we've seen values fall by a little bit more than 7% across Australia's combined capital cities. So we're only just recently coming out of that, what you might call a correction phase, coming into what you might call a recovery phase in the housing market. Still early days though, so there's a lot of headwinds in the market. We've seen softness in the labour market, for example. Business conditions are still pretty patchy. We're not seeing as many full-time jobs being created. What really flows through to is confidence in housing. So even though we've seen values rise across housing markets by about 3% since they bottomed out in May last year, we aren't really forecasting very strong capital growth over the remaining year, probably even over the next couple of years. If we see property values increase by say 4 to 5%, which should be in about line with wages growth, that will be a good outcome. So that's one of the opportunities in one sense, but also one of the risks, in that we are coming into a marketplace that's likely to be characterised by growth in the housing market, but not the same level of growth as we've seen over the past decade. The other factor to consider when you're looking at housing markets is the fact that it's generally a fairly low yielding asset. Okay, gross yields across housing is about 4.2% on average. Some cities like Perth are a bit higher, around the 4.5. Units tend to be much better yielding than houses. Unit yields tend to be up around the low 5% mark on average. Inner city units quite a bit higher. So investors need to keep that in mind, that if they are looking for an asset class that's going to be high capital growth, you really need a pretty decent time frame to amortise that out over now for the housing market.
You sound a bit more optimistic, I imagine, than you would have been this time last year?
This time last year, the housing market was absolutely in the doldrums. Yeah. Confidence was low, values were still going backwards. It wasn't until we saw this interest rate cutting cycle, which commenced in late 2011, that really started to see some confidence come back into housing. And it wasn't really until May last year, May 2012, that we started to see the market turn around. So the recovery phase is still pretty early.
Okay. Can you give us an idea what are some of the key factors likely to be influencing property markets as we move forward?
Well, I think the number one factor is all going to be about confidence. We haven't seen consumers or businesses respond to the low interest rate environment as we would normally expect them to. Interestingly, consumer confidence data just recently came out from Westpac, which showed the fourth consecutive improvement in consumer confidence. So we're starting to see consumers once again view investing, particularly in housing, in a much better light than they were, say, a year ago. Confidence is back to levels we haven't seen since December 2010. But on the other hand, business confidence remains really low, which is going to affect businesses putting on new staff. It's going to affect businesses putting on more inventory, for example, or forward inventory, which is going to have a flow-through effect on the economy. So I think that's the big wild card, is what happens with labour market and how is that going to pass through into asset classes. Commercial properties yielding much higher than residential properties. You should generally expect net yields to be up around the 7% mark at least for retail investments or industrial investments or office market investments. Housing markets certainly much lower than that, probably around the 4 to 5% mark gross.
And my final question to you is, given that your surname is Lawless, how many times have you had people make references to your name, given that you work in the investment community?
It's pretty rare. Maybe that's a factor of politeness.
Okay, so I'm glad to be less polite than most people who speak to you.
No, I wouldn't say that, but generally if people do raise it, it's in relation to Lucy Lawless for some reason.
Okay, the Xena, the warrior princess. There we go, we've covered a lot of ground in a short period of time. Tim Lawless, thank you very much.
Thanks very much,
Andrew.
Andrew.
Cheers.
Cheers.